All right, so today we're going to get into the balance sheet, the income statement, which is also referred to as the profit loss statement, and the cash flow statement, and the ratios that are used to measure performance and success performance of a company. Um, and then I also want to, because that we needed to get through this, then I want to what do I want to say? Start assigning companies so that you can start working on your final project for the end of the semester. So it looks like we're up to, oh, there's another face. So I did have a question. If anybody in the class knows how to uh, take care of, like, honestly, I don't know the difference between a plant and a flower, but I guess flowers. Um, my mother had a green thumb. I think I have rocks for thumbs. I bought these flowers last week and they are dying left and right. I decided I'd try to do something nice. I'm still moving into this apartment, but like I bought these
I didn't spill anything.
and this thing snapped in half just sitting in the vase. And then I read you're supposed to put sugar in it, so I put sugar in it. And I even bought two grow lamps, and I don't know what the heck I'm doing.
Are those sunflowers?
Yeah, and I'm doing a terrible job. I because I
I mean,
guess
I get them for my wife every now and again. She likes them. I think she puts, hey babe, what do you put in the water for sunflowers?
yeah, the only thing that grows is like I got these as filler for another plant, and the filler stayed alive and the plant died, and they're not even
Ah,
old.
are you putting it in the sun?
Yeah, I not only have sun, I went out and bought three of these things. Grow lamp.
Oh, wow.
Yeah, I'm trying to like. Thank God I don't have pets.
Yeah,
I,
that's good.
it's always. I mean, when I was a kid, I had lizards and snakes and
Ugh,
turtles and frogs, and
Jesus.
and I like in the South there were dogs and then a couple of cows and horses. But your standard. Yeah, I can't. Anyway. I'm not depressed over it, but I'm frustrated that I can't keep a simple plant alive.
It's okay.
I tried talking to it. I threatened it.
That probably didn't help.
Well, it was already dead.
Oh yeah,
Told it to come back to life, and I think it
then it
left.
had it coming. I think it was a Japanese experiment. They like talked to rice and like they talked bad to one and they talked good to the other. And the one they talked good to lasted way longer.
Really?
Yeah.
All right. So we're gonna set up brothers, siblings, peer pressure. I'm gonna tell one, you're a good plant. I'm gonna tell the other, I don't know why I had you.
Exactly. Yeah.
All right, we'll see how that
We'll
works.
experiment.
I'll try anything because trying to do what I think is right is not working. Yeah,
Did
it's
you
very
put
frustrating.
the plant food in there?
I tried it in the previous apartment and what happened? Something I think it's attracted fleas or something. And so I threw it away.
Please.
Yeah, I, anyway, if anybody has some secrets, um, I could use them because when they die, I'm not buying anymore. I'm gonna get a picture of a plant. And that's gonna be the best I could do.
Yeah, that's good. It'll stay
Uh,
forever. Or get plastic plants.
yeah, because I have anyway, I I did it with good intent and it just didn't work.
I get it.
Yeah. So all right. Um, anyway, welcome back to class. I hope you enjoyed the 3-day weekend. And for those of you who are Cowboy fans, too bad
Ah,
because
it
my
was
Niners
beautiful.
beat the snot out of them. So
Yeah,
when on the West Coast in the Bay Area, the Niners don't like the Cowboys, and the Cowboys don't like the Niners, and they both have I think 5 rings or something like that. So
Cowboys have four, Niners have five.
okay, so anyway, so I'm looking for that's right. So I'm looking forward to a good year. So anyway, so that made me happy.
They're looking good, man. They're looking real good. Brock Purdy, am I,
Mr. Irrelevant, number
he's
262 draft pick that nobody even cared about.
looking great. Yeah, me and my wife watched the game and we were just laughing our asses off.
Yeah.
But she roots for my Jets. I root for her Niners.
Well,
It's
okay. I'm not going to make any comments.
yeah, it's tough to root for the Jets, but I can root for her Niners. They look good.
Yeah. So, all right. So I'll stop being mean. But all right. So let's get into it. Let's get into the meat of accounting. So let me open this up. So I'm going to go straight to the to slides because this is the part that's numbers. And I actually let me just stop there for a second um, because I wanted to. Oh, someone's got a chat. Let's see what's going on here. I just oh, dry them out while they're fresh and put them in vases so they stay alive, but they can't. Oh, all right. Zinni, because I took them straight out of the whatever they gave them to me, and they were still slightly wet. And my mother used to cut the bottoms off and then stick them in, and she said that that would somehow invigorate them or something. But I can take them out again and dry them out and see. Maybe I'm putting too much water. I don't know. Zinni, hang out at the end, please, because I will be your student. I will do whatever you say because I can't. It can't be worse than what I'm doing now. This is terrible. Yes, I know my weakness. I can't grow plants.
Hmm.
But I'm going to keep trying. I have to be an example to my students. I can never give up. All right. So what I did was I looked up some current salary ranges for accounting, just to give you an incentive. So corporate accounting, there's private accounting and there's public accounting. So private accounting is when you work for a company. Let's say you work for a publishing company in New York or a large law firm, a bank. Let's say outside of New York, a car company, Procter and Gamble. Any of these companies, they're going to have accountants on the inside. Why? Because we learned that you have budgetary and financial accounting. The budgetary is that the different groups in the company have to figure out what their budget's going to be, and accountants have to figure out where the numbers are, and then each group gets a budget to manage their department. So my experience was as an engineer, as a product manager, um, I had to request $5 million to put a, um, a demo model of a server together to be able to prove that it could work. Well, that came out of a budget, and the budget was set up for my department. Um, so that's internal to the company, and then the financial accountants also would help to for partners, for investors, for bankers, and eventually the IRS. So they want to see how the company is performing financially. Now, the public accounting, like KPMG, Ernst Young, Deloitte Touche, um, Ernst Young. There's the big four. I can't think of the fourth one, and they're all here in New York. They are billable from the outside, kind of like you think of a lawyer. So they would actually work with the very same company, independent of the company, to help them prepare to figure out how to process the numbers within the company, to do things like set up budgets and prepare for investor meetings, and also prepare paperwork for the IRS. The public accounting you have to have someone in the firm who has a CPA, or they're a certified public accountant, which means that they have passed whatever licensing that are required. And there's a lot of updates to that because accounting rules change almost yearly. So, for instance, during the pandemic, there was money handed out to people. There were monies that were supporting families with children, all those kind of things. Well, this impacted accounting because how do you report on all of this? And there's lots of other things like that. So this, I found this on ZipRecruiter, and it shows that the average salary is 110,000, and you can go up to 162. and it's a field that's in demand. And in the federal government, they're looking for people with these skills because under the Biden administration, they got approval for more budget to hire more people in the IRS. And so they need people who understand accounting practices. And what's interesting is people will argue that a lot of what the IRS does is focused on people who don't make as much and not on people who make a lot. And that's one of the reasons they need more accountants, because the people who make a lot are hiring their own personal accountants who are very clever. And so the IRS's challenge was figuring out how to understand what they're doing and if they're breaking any rules and things like that. So you could work in the private sector, you can work in the public sector. And then the other side was these are public accounting. So, and then to different levels. So associate, senior, accountants will do an audit of a company. You'd rather get a public accounting firm audit you to figure out what you're doing right and wrong and how to improve it than to have the IRS audit you. And that usually means you're in a lot of trouble. They can shut you down. So you have people who do audits, you have senior managers, you have tax associates who understand the rules of the tax law, and the tax code, and then senior tax associates, manager of those services, and then senior managers. So you can see that there's a number of different levels of pay. And if you're an associate, you may not have the CPA. So you're working in the firm to help put information together, but the person with the CPA has to sign off on it in the end. All right. So it's a good field to go into. There's a lot of growth in it. It's a growing area, which means there's a lot of opportunity. And the fact that you guys are in New York, going to a school in New York, especially if you go on to get your 4-year, you don't have to go far to find a job, because all the big 4 firms are right here in New York. So anyway, so I figured let me start out with that just to give you kind of an idea of what the incentive or opportunities are for you. All right, so let's get into slides. So I'm going to use both slides, but mostly I'm going to use the one that comes with the book, because the thing about numbers is you don't really need pictures, because we're getting into numbers. So we last week kind of got into the front part of this, which I kind of went over a little bit just now. But now we want to get into the cycle of how you prepare, and then what each report looks like, and understand those reports, and then get into the ratios of the summary, and then try to use some examples to kind of drive this stuff home. When you look at accounting, unless your family owns a firm or you're working in an accounting department, sometimes it could be a little confusing about the cycle. But we've all shopped in stores like bodegas, etc. And for years, if you went in and actually purchased something, that would be rung up on a register for sale, and now it's digitized, which means they're going into electronic spreadsheets. And there's a number of software programs out that small businesses can actually use. And you don't have to be a grocery store, you could be anything, but it automatically dumps the information into the spreadsheet so that that doesn't take a long time. But in the past, the person running, who is a proprietor, would have a book, and every time a sale would go in, or if they had to make a purchase, like there was a delivery of product, etc., things like that, they would enter it into a book, and then later, either in the store, or they go home with the book, and then they would organize that into different areas, like money that goes into paying for utility, paying for salary, which are expenses, or buying product like inventory, or buying assets, like maybe they have to replace some shelves, or replace the air conditioning unit, etc. inside. And all of these are going to go into different areas. And they have to do that legally, because they have to account for all of it. Because if you are in the United States of America, or any of the territories, you have to pay federal tax. And then depending on what state you are, you have to pay sales tax, And some states you don't pay income tax. And then some places like New York have city tax. So some people who live in Yonkers pay a different type of city tax because they are their own um, city. They have their own mayor, right? If you work in New Jersey and live in New York, you pay tax differently as well because you're working in a different state. And then there's people who travel. So this course doesn't get into the sophistication of stuff like that. We stick with basic accounting. And then there's accounting for nonprofits. There's accounting for the public sector, like accounting for a city like New York is very different than running a business or even a nonprofit like the church or the library or a museum. And then there's for-profit accounting. And typically most accounting courses focus on the for-profit, which is called corporate accounting. And then there's, of course, cost accounting, which is kind of a subset, which is to figure out at the end of the day what business you're in. So they start figuring out where you're making money, where you're not making money, or in other words, losing money. So for instance, if I'm a furniture store and I sell tables and chairs around Thanksgiving, I think I'm making money on the chairs and tables. And it may be that people are coming in to buy the tables, but they're paying less for the chairs to the point where the tables are also subsidizing the cost of the chairs. So you're not really in the business of selling chairs, you're in the business of selling tables. And sometimes businesses realize that, and so they kind of change how they do their business by selling things from partner organizations. Like if you're a hair salon, you probably don't make your hair products because it would be too expensive and you would wind up subsidizing the cost of making the hair products with the haircuts. So you just buy a third party's product and then put a margin on it, like add an additional amount for profit because you have a captured audience or customer because they really like the way it worked when you use it in their hair. A cost accounting will actually figure that out. All right. And so in this case, they're kind of doing a very high level view of organizing the information before preparing final reports, which are for IRS, for banks who want to understand how, they want to get a breakdown of you making money or not making money. Investors who may invest in your business. You start a business and you want angel equity, venture capital, or just your uncle down the road that says, hey, look, I'm willing to give you some money to start your business. They still need to see the organization of your paperwork. And then because it's easier to see things in diagrams than to see it in numbers, you can then take this information in the report form and put it into a visual format. And so this is kind of the high level view. And then, as I pointed out, you have managerial that's internal for budgeting purposes, sales reports, production costs, and some others. And then the outside for investors, lenders like banks, and then, of course, the IRS. All right, so this is the first screen that you want to remember. And if for no other reason, if you're not interested in going into finance or accounting or something along the, or even investment banking, it will probably show up on a quiz. So I would remember this stuff. So it's referred to as the 6 steps. All books typically refer to it as 6 steps. And they all basically say the same thing over and over. Sometimes some of the language may be different, but it's essentially the same thing. So the first step is analyze business transaction documents. So again, imagine you're running a store 20 years ago, 30 years ago, and you've got this big book behind the counter, and every time there's a transaction, you put it in there. So it's a general ledger, and it's organized by date and time. And it has to be organized that way because you could go in later and say, well, I did make this money or I didn't make this money, which is committing fraud, which is against the law, and you can get in trouble. You can be fined. And if it's really significant, especially if it affects other people, you go to jail. So you are required to maintain accurate books of accounting, right? And so it's going into this general ledger and you're marketing as such. And then because nowadays you don't have a book behind the counter, you have a register that's connected to a computer. And the computer now, instead of you having to spend hours and hours and hours of organizing this information, um, the software will dump it into the different records. So it'll put it into the general ledger and then almost automatically um, organize it into the different journal ledger entries. So, you know, investment or purchase of assets, expenses, paid for the utility bill, paid for the salaries of the employees, right? These are expenses to the business. You know, an asset is something that you purchase and you own. So you bought some shelves, those shelves belong to you and your business, right? That's a different category. And then there's some that show up in accounts payable and accounts receivable. So if you have a business that the product, you have a hair salon and someone pays for with a credit card, you don't see the money immediately. The money has to go through a process with the credit card company like MasterCard, and then eventually it shows up. But immediately it becomes accounts receivable because it's an account that you're waiting to receive money on. It may be that you're paying something out, which is an accounts payable. So you are paying something also on credit card, or you owe some money that you haven't paid on yet. So you have money going into a bucket that shows up that at a particular time you pay on. So if you can manage it, you always pay your money at the last minute. Now, most people do that with some things like the rent. Some people don't do that like a bill. The reason I say that is because there's this thing called time value of money, which is called float. And what I mean by that is, let's say you have a business and you have to pay $100,000 a month for something. I don't know. Maybe it's a mortgage on a commercial business. Well, instead of paying it on day one, I would rather pay it on the last possible day. Why? Because I can keep that $100,000 in an account. And these days, even a savings account will give you up to 4%. And 4% of $100,000 over the year by doing this is $4,000. And if you then add 100,000 times 12, it's 12 times 4,000, right? So that's what, $48,000. So there's value. Time equals money, right? And so holding onto your money until the last minute means that you could leave your money in an investable area until it needs to be spent. That's money you would have lost if you spent it up front. So therefore, most big businesses that will spend millions of dollars per month, think about UPS, Federal Express, and DHL around Christmas time, when they each one hires up to 80,000 extra employees to get through the Christmas season, to get all the packages in and out. That extra money they have to pay is in the millions. So it's very easily that you're spending millions of dollars in a short period of time. So where I'm talking about 100,000, think about it in terms of millions. They're not going to pay it as quickly as possible. They're going to pay it at the last minute. So therefore, we would have an accounts payable, and we're going to see later on where accounts payable can be broken up into salary payables, tax payables, notes payable. They can actually break down into finer detail. So you go from analyzing, it goes from the general ledger, you post it into these other specific, like it says here, cash, accounts receivable, et cetera. It's different ones. Then you prepare a trial balance, which is to organize it. And we're going to see later that accounting forms are either left to right or vertically organized. So, for instance, when we look at I think this is it. No, it's not it. So So if we look here and I were to type in Apple, I got too many tabs open. If it would ever come back. Oh, there we go. So if I type here and I look at Apple, right? And I slide over to financials. And the first one that shows up is income statement. You can see because of the way the computer lays things out, it's north to south, right? Because this is the year 2020, 2021, 2022. And TTM only means like today is October 10th. So from October 10th, 2022 to October 10th, 2023, which is interesting because their fiscal year at Apple ended on September 30th, but they're looking at how much money is being made over a year to date, meaning over the 12 months previous to today. And then if you slide down, you can see everything kind of goes vertical, north to south. Where it really shows up is when we look in the balance sheet, because we have three sections. We have assets, liability, and equity. And in some cases, you will see assets on the left side and equity and liability together on the right side. But again, because of the way computers lay these things out, and because we're looking at 3 years, you see the assets are on the top. And then if the screen would refresh fast enough, you would see then liabilities, and then you would see, actually you see it right here. You see assets, liability, and equity. And so if I click on these, you see the current asset, and then I can see non-current, which is long-term asset. And then if I go down here to liability, I have current liabilities and long-term liabilities. We'll get into what those mean later. And then you'll see the equity, which is how much you own, right? And so the way this is laid out, it's north to south. But in most like paper documents, for instance, you'll see assets on the left side, and then you'll see liabilities and equity on the right side, because you will see in a moment that the famous equation is assets equals liability plus equity. And we'll get into why that is the way it is. But it's important to understand at least how things are laid out so that you're comfortable and familiar with them before we get into what these different things, what these things are. All right, let's go back to our slide. Oh, there it is. And all right, so and then after you create a trial balance, and in a large firm, this is where the public accounting firm would work with you to put a trial balance together. Then you prepare the financial statements, because some, again, are managerial, some are financial, some are meant for internal use. And sometimes that internal use is not meant for eyes outside because you don't want your competitors looking at it. And then you have some for the IRS and for banking, accounting. And then you have your, then you analyze reports. And of course, you have your ratios at that point, figuring out how profitable are you, that kind of thing. All right. So the next one is the equation. Let's see. It's weird because the equation doesn't show up on this set of slides, which I don't know why, but it shows up on the other set. So let me switch over to the other one. And I already have it set up. So the next is the equation. So assets equal liabilities plus owner's equity. All right, so what does that mean? So, I have to always assume you've read the chapter. So can anyone help me understand, what does that equation mean? An asset is something that at some point you purchase and you own, or you create it and you own. Liability is something that you owe. You have a liability because you have a responsibility to pay something back, kind of like a mortgage or a home loan or rent or tax or salaries. These are liabilities. And then owner's equity is something you own. But can you explain how this equation works?
Assets equals liability plus owner's
So
equity.
do something simple like a house.
Yeah.
You go buy a house for $700,000.
Well,
how much do you have to put down normally to buy a home in America?
uh, isn't it 5%?
Well, special loans, especially if you're military, you get some special breaks, but
I get
normally,
0%, which is pretty cool.
well,
But
okay, we're all jealous. So,
yeah,
but normally you have to put 20% down,
is it
right?
20%? Wow.
Yeah. Yeah, for us laypersons, for us citizens, anyway, 20%. So if the
Okay.
house is $700,000, how much do you have to put down?
20%. Is that 14,000?
A little bit more than 14. That would be 2%.
Oh, no? Oh, yeah, you're right. So, be 140,000.
Yeah, so you have to put 140,000. So you can do the math. If it's $100,000 house, right?
Yeah,
It would be 20 grand, right? Because 20% of 100 is 20, and on the way
right.
up, so a million, would be 200,000. So we have a $700,000 house, and you laid down $140,000. Maybe I should work with the where is it? Uh, where is it? Where is it? There it is. Lights. Yeah, maybe it's a little easier. Oh my goodness, they made changes to this too.
What is this? Oh, is it like a Blackboard thing?
Yeah, but it literally just changed today because it was updating when I turned you guys on. So now I have to figure out where everything is. Yeah, this sounds like a Silicon Valley issue where they don't realize real people are using this. All right, so we know that assets equal liabilities plus equity. All right.
Okay.
So our example is we take a house for $700,000,
Hmm.
and the down payment equals normally 20%. There are some programs for less, even if you're not in the military, but I don't want to get into,
Yeah,
I'm going to keep it
the
simple.
weeds.
Yeah, exactly. So 20% would equal $140,000, right?
Okay.
So before I move forward, of the numbers of the um uh the 700,000 and the 140,000, if we look at the equation of asset, liability, and equity, oh, and by the way, so your mortgage is what?
It's like your monthly payment.
Yeah, but how much is it?
Geez, 30-year mortgage
Well, look at the
divided,
numbers here. Look at the numbers here. The mortgage you get from a bank, right? And the
right,
mortgage is the bank gives you money to do what?
to pay for the house.
Right. And so you've already dumped 140,000. So how much more of a mortgage do you need?
560,000.
Yeah. So there you go. So it's $560,000 for the mortgage, right? And you
Yep.
figured it out by doing what?
Subtracting 700,000 from 140,000.
Well, the other way around, but yes.
Yeah.
So you came, and then of course the bank doesn't do it for free. They charge what?
Surcharge or like
Surcharge?
or whatever you call it, like a
Interest.
interest. Yeah, there you go.
Right. So they charge interest. And these days, of course, we know that interest rates are higher because the Federal Reserve has been raising the primary rate. We know that it's 2% the bank's going to charge because it costs 2% of money to manage money. So
Hmm.
I forget where it's at right now.
It's like 7 something.
Okay, so let's say it's 7 plus 2% would be 9. So
Uh-huh.
and then the bank then has to charge a little bit more because it's trying to make a profit like any other business. So they're
Right.
paying 2% to manage money. The prime is 7, that's 9, and let's say it's another 0.5%, could be a quarter or something like that. But so right now the interest rate is probably going to be around 7.5%, and
Okay.
and it could be over 10 years, 15 years, 30 years. And of course, it's you probably want to get a fixed rate, not an adjustable rate, meaning
Right.
after 5 years, you pay 000, and then all of a sudden you pay whatever it is. And that's how people got in trouble in 2008 because it ballooned up to a crazy number because we were in a recession.
Hmm.
So if you're buying a home, you want to try very, because you guys are all pretty young. So, you got more than enough time to pay it over time. And we can talk about how that works when you buy a home. But for now, let's focus on the accounting equation. So of these numbers, we have 700,000, we have 140,000, and we have 560,000. So which one is which?
Well, equity would be your, would it be the
I'll tell you
140,000?
what, let's do it this way. Let's get everybody to participate. So, John, throw
Yeah,
out what you believe it is, and then I'm going to ask the class to raise your hand if you agree with John, and if you don't, what do you think it is? That way we can get a little bit more
yeah, I
involved.
feel the equity would be the 140,000.
All right. So if you
Or no, it would be the 560,000, I think.
okay. So John believes that the 560,000 is the equity. So for those of you who don't agree, could you put your hand up? So somewhere on your Zoom, you've got like a little hand somewhere, something like that, I think. Actually, I've never used it because I've always no, I can't say that I have used it. So I mean, if you don't know how to use the hand, then jump in on the chat. So if you don't agree with John, either throw something into the chat.
No, it's the down payment. It's 140,000.
So if you agree with John, if you would raise your hand, I'm trying to. Okay, if I don't see a hand go up, I'm going to start asking people one at a time. So you may want to get involved. Miracle, do you agree with John? Miracle? Miracle. All right, so looks like I'm going to have to start talking to people one-on-one to make sure we're all there. Martin, I think the liability is the mortgage. All right, good. So how many people would agree with Martin? Martin believes that the liability is the mortgage.
Yeah, I agree with that.
All right, so I have one. Anna says me. Says I'm assuming Anna me means you agree. Is that what you? Oh, me too. Brian and Harlan agrees also. Okay, so we got some participation now. So let's get somebody else. So Harlan, you agree that the mortgage would be the liability. Can you tell me why you came to that decision or how you came to that decision?
Because wouldn't the mortgage be like a loan that you have to pay back?
Good. Mortgage is a loan because the bank loaned it to you. And so the fact that you have to pay it back, that means it becomes what? You're
A
carrying,
liability?
right, you're carrying a liability because and the word liability has a very heavy sound to it. It almost sounds like the bank is thinking you might be a risk because you're a liability. Because we in normal English, American English terms, liability is used beyond accounting and saying this person is a liability to our firm, this person is a liability to our team, etc. Um, and unfortunately, if you're not originally from America, English words can be very confusing because they mean more than one thing. But in accounting, a liability means that the bank saw you as a risk. And just because I said you a risk doesn't mean a bad thing. You could be a small risk, you could be a big risk. And that's how the interest rate tends to fluctuate based on the level of risk. But at the end of the day, you're still a risk because, especially for the 30-year mortgage, that's a long time. So is the person taking the mortgage out going to pay this mortgage back over 30 years or however long it takes them to pay it back? Because they may sell halfway through and then pay it down right away and go into a bigger house, which is how you build on generational wealth in real estate. But that's another story. All right, so I think we all agree that the mortgage is the liability, but no one has given me one way or the other. Do you or do you not agree with John that the down payment of 140,000 is equity? If you agree, tell me, and if you don't, tell me. Christopher, do you agree with John that the 140,000 is equity? Christopher. Hey guys, I'm gonna start doing this more often because if you're disappearing off the screen, um, then I'm gonna keep track of it. So I strongly suggest that you jump in. Um, Ariana, do you agree with John? All right. Um, okay, so Martin, because isn't equity your stake ownership or something? Yes, yes. So Martin, that's actually a great way to put it because um, you because it's your stake. I like the term stake. In other words, if you play poker, they never real poker players won't play for free. They say put some stake in the game because we're all taking a risk, right? And so you put your chunk in there until you lose it. So in this case, you put 140 grand into this house, and then the bank says, okay, you put in 20%, we'll put in the 80%. That's kind of how it works. All right. So the next one is so then what does that leave us? What does that leave us? What does that leave us? Ryan, what does that leave us? Ryan, if you don't understand something or you're still not sure, just tell me you don't understand it. But I need to know you guys are getting involved in this. So Brian put me question mark. I'm not really sure what that means.
I think he thought you were talking to him.
Oh, I'm sorry.
Yeah.
Oh, I'm sorry. I was saying Ryan. Yeah, Ryan, Brian. Sorry. Okay. Well, then, Brian, sure. Give it a shot. Where does that leave us?
Wait, what was the question?
Well, we know what 140,000 is. We know that's equity. We know that 560,000 is the mortgage. It's the loan. It's the liability because it's what we owe. So where does that leave us?
With the interest, the 7.5 interest.
No, forget about the interest part. Think about just the house part. So what other number do you see there?
Those 700,000.
So what is that?
The value of the home.
Look at the equation. Yes, you're right. You're right. So look at the equation. Look at the equation. So which of
That's
those is it?
the asset. The asset.
Right. Right. And so now go back to what you just said. So the asset value is
Is the 700,000.
exactly. And so when you said that it's the value of the home, here's the big question for everybody. Who decided that it was 700,000? Give it a shot, Brian.
The past owners, right? Or the bank.
Well, the bank probably assessed it. Matter of fact, sometimes people overprice. You can sell your house for 10 cents. You can sell your house for $1 million. It doesn't mean anybody's going to pay for it for that much. But the bank will have an assessor go in because you know why? Because you have to pay real estate tax. And if you look on Zillow for some of the houses, you will see that some houses, if you look at the Martin's correct, the market determines everything because sometimes the value in the city of New York, the asset value of your house normally goes up 3% a year. So if you buy a house today, like if you go into Brooklyn and buy a brownstone for $3 million, right? In 10 years, if you multiply it by 1.03%, then that number by 1.03%, and you do that for the next 10 years, your house should be greater than 30%. The reason it's greater because you're also increasing it 1.3% on top of the one that was 1.3%. I hope I'm making sense. But 10 times 3% is 30%. 30% is approximately a third. So your $3 million house should be worth 30% more. So 30% of 3 million is what? $30% of 3 million is what?
900,000.
900,000. So your house should be worth between 3.9 million and $4 million in just 10 years. in just 10 years. So I know young people who've gone in and taken a brownstone and carved it up into a bunch of apartments, or more than one person will go in. There's a group of students from Columbia that decided they were so young, they said, we're going to graduate, move to Detroit, and buy every house off the block, because at the time that the economy was so bad, you could buy a bombed out house for $500, and they would dump a few $1,000s and build it up. And they decided to do all the houses, and then they started selling it. And now they have a TV program with one of these this gay couple that does it, where it's they build up these houses that they buy for $5,000 or $6,000. And one of the banks liked what they were doing so much that they said, we want you to come and do the same thing in Cleveland. So there's a lot of upside things that you can do. But New York, because there's good jobs, it's a transient market. There's place, I mean, the South Bronx is going through gentrification and evolution. So you can look at it as an opportunity. You can jump into something like this, but that generally is what happens, right? So, like if I were to, where's my screen? There we go. If I go over, no, that's not it. Christmas, where is it? Okay, there it is. I have too many things open. So if I go into so if I go into Zillow and I type in, let's see, Brooklyn, New York. And oh, can't believe that there's a home that cheap. But there's a range of 3 to 500,000. They've got, let's see what this one is. You got a condo here that someone just posted 18 hours ago. If this thing comes back, I'm gonna close some of these windows down because I'm killing my anyway, when it comes back, I'm going to roll it down and you're going to see where the tax assessment is. And the tax assessment is done by the city. There's some cities where people have been corrupt and they've kind of tried to get people to do things. Trump is one of the people who's in trouble because of that, because he was having paying off people to assess property for when he wanted to look like he was worth more, assess it high, and when he needed to finance it, assess it low. So here's Zillow. You can look at an apartment. You go down here, and if you keep going down, show dates, description, keep going down. Here is what the market range is for this area. So, and then if you rent it out, what it's worth. So Zillow does a good job of showing this. It shows over a period of time. The price has been going up since 2018. Some of them have a longer, and then the tax. So the tax assessment on this property is $37,252. Right. And so here's the problem. If you go to buy it, right, the bank says the property is only worth $37,252. So you got to come up with a lot of cash. I mean, they're not all this bad. Some of them are much closer to the value of the house, and some are much lower. But this is a case with inflation because there's so few properties on the market. What most places will do is they will price it 20% above the assessment, knowing that you have to drop 20%, because what they don't want to do is scare away buyers who are trying to get a mortgage, because the bank's going to look at it and say, wait a minute, unless the bank really thinks you're worth it, they're not going to give you a loan greater than this amount. So this is part of the problem with buying it. And then of course you have, oh, this place has a homeowners association. That's really high.
That's
And then
crazy.
there's insurance, and then there's tax on the property. And then if you're kind of a questionable person, they may make you take insurance out on the loan because you may default on the loan. And then there's the principal. This is the only part paying for it. And for the first 10 years, you pay 90% into the mortgage interest rate. Then you start paying down the principal, right? So if you want to learn this stuff, just go on Zillow and pick a property anywhere you want, almost in the world, because Zillow's everywhere. All right.
Estimated payment 50,000 a month.
Because the loan is
That's
probably not going
crazy.
to be more than 37. So I have a feeling this is a property that's either going to sell for cash, because there are plenty of people in New York. If it's a nice area like near Prospect Park or something like that, there's plenty of people who work in Wall Street whose bonuses are hundreds of thousands of dollars. They could literally go in there and just drop cash on it, or they sell a property and they take the part of the money they make off it and just buy the home for cash.
Yeah.
Yeah, that's not normal. New York is a weird city.
It's very
Go pick
weird.
a place in Vegas or some nice suburb in Long Island or New Jersey, and you will see that the price they make, they adjust it to the assessor's adjustment, because they say, we figure you're going to come off with 20%, because if they do it too high, you can't get a mortgage high enough. All right. So let's go back to our slides because, actually, where's my white screen, just to finish out the whiteboard. So what we've learned here is that the asset 700,000 equals the liability, which is the loan 560,000 plus equity is 140. In 2008, we had two things happen: a credit default swap crisis, and there were some people who were doing some bad things as far as real estate. They were talking people into these adjustable rate mortgages that after 3 years, 4 years, 5 years, and it started out at 0%, were suddenly blown up, and what they were paying in the hundreds on the interest suddenly were 3,000, and they were underwater, meaning they didn't make enough money. And some people were doing things as bad as lying about what people's incomes were to get them into it. And so they were losing their homes and walking out and moving into tents. 2008 was a really bad year, 2007, 2008. And Lehman Brothers folded. There were some banks that closed. Morningside or whatever it was, the company that wrote mortgages, a number of companies closed and people went to jail because they did some bad things. My point is this: if the economy goes down and there's plenty of houses, the value of the house could go down because people don't have the money, but people are still trying to sell. If the economy does well, which is what's happening now, houses over the pandemic jumped from the beginning of the pandemic, when interest rates were close to 2 and 3%. From 2020 to 2021, houses were jumping $100,000, and the only reason they're not moving up even faster now is because the interest rates on loans, but they're still high because there's not a lot of supply. And if you live in a house and you're paying 2% or 3% and you hate your neighborhood, why tell me a reason why you won't sell that house right now? So you live in a house, it's a $700,000 house, you refinance your interest at the beginning of the pandemic down to say 3%, and your neighborhood is horrible, you want to leave, and you know where you want to move. Why won't you sell your house?
Why won't you sell your house?
Anyway,
Because there's not enough money to make on it.
okay, you're gonna have to be more specific.
So so you want to move, and what's the market? Is it down or is it up?
Let's see. So Harlan said it wouldn't match market value. Which would it mean? The sale of the house? It's still going to be 700,000. There's not a lot of inventory out there, so that's why housing prices are not going down that much. So the
You'd lose
value of
money.
your house is still worth it, and you probably won't find another home. That's the answer. So Brian says, I won't find another with the same interest rate. Why would you leave a 2 to 3% interest rate, even if you found the perfect house, right? Even if you found someone to buy your house, you now are going to move, and most likely you're going to go into a bigger house, one that costs more. Like, why would you're going to roll the equity over into a bigger house, because your payments, if it's still 2 to 3%, are going to be the same. But now, instead of a $700,000 house, you have an 8 or a 9 or $1 million house, and your mortgage rate's the same because your house increased. Remember, over 10 years, you suddenly had 900,000 extra dollars that you could roll over into the next house. But Brian brings up the point, even if I found the perfect house, even if I found someone to buy my house, I now have to move. I have to double my interest rate, which means that my mortgage payments are going to go up. So that's this weird situation we're in right now in the United States. And during the pandemic, there were no houses being built because of the pandemic, right? You couldn't have people next to one another and you're supposed to shelter in place, right? And now the raw materials, because of inflation, has gone up. So the cost of woods and tools are up. The number of people building are not as many. So there's actually a demand for people who are skilled laborers to build homes. And because of inflation, interest rates are high. And so you have low supply, high interest rates, and people are stuck. And what does that do? It's beyond this chapter of this course, but it actually causes rent rates to go up because people have to live somewhere. And so people who are setting up rental apartments are like, well, you got to live somewhere, and you got enough money to pay a mortgage this big. You probably can afford $3,000 to $4,000 for a 1-bedroom, and $5,000 to $6,000 to $7,000 for a 2, and $8,000 to $9,000 for a 3. And that's exactly what's happening. And what's that called? The market. The market will pay what the market will pay. And so those with ownership of places are going to exploit the opportunity, because that's called free capitalism. I'm going to sell my service and products for the highest price that I can get, with some exception. There are some things that are regulated and you can't exploit people. But if you own a home and somebody wants to pay you twice what you paid for it, God love you. Go out and sell your house for more, right? So that's kind of what's going on. But it gives us context into understanding how the equation works, and also what each one of these means. So the asset value is determined by this. And you may say, well, then how is liability and equity staying the same if the market is increasing asset value? If the asset value of the house goes up from $700,000 to $800,000, what happens on the right side of the equation? Anybody?
Say that again?
If the market suddenly, so I suspect that next year interest rates are going to come down, right? I suspect that inflation is finally going to cool off. We have a presidential election year. Biden is going to want to get as many people to vote. And the best way to do that is to give them cheap money. So stock prices are going to go up. More people are going to get hired. And there's going to be more money on the streets. So interest rates are going to come down. As a result, more houses are going to go up for sale. And I suspect that asset values are going to go up. So I suspect in 2024 that this $700,000 house is going to shoot straight up to $800,000. Well, if the asset side, the market value goes up to $800,000, and this equation is supposedly always true no matter what, then how is this reflected on the right side of the equation? What happens?
So if the house is now worth 800,000, that means your equity would go up 100,000.
Right. That's right. And so we need to understand that, because we put our own hard-earned 140,000 into the house. We didn't put the additional 100,000 in, but because the value of the house went up, it did not change the cost, the liability of the mortgage. The mortgage is the mortgage is the mortgage. A mortgage or a loan is a contract. A contract is legally binding. The bank can't come in and say, well, the market price went up, therefore I'm going to make you pay more. No, I could take that bank to court and win every single day and twice on Sunday, right? If the court was open, right? So the mortgage, which is a contract, it's a binding contract that I can get John to put his uniform back on and protect the citizens of the United States from a predatory bank or England trying to get more money out of us back in the days, right? So this won't change. The liability, what you owe, stays the same. It's an agreed upon contract, but the equity value of the house suddenly goes up, and you want it to go up. You want that situation where the liability stays here and the equity value on the house goes up because the asset value goes up, and you want to sit on that house for a number of years so that you get enough that your next house that you want to move into, you're going to roll that big chunk of equity over into that next house. You know, and just to finish out this whole argument of an example, the reason you probably, unless you have to, everybody has a different life. Unless you have to, you don't want to take the equity out, because here's the thing: when you roll this equity into another house, it's not affected as a gain, as a capital gain. If you take this money out, let's say it goes up 100,000 to 800,000, and you say, I'm going to leave 50,000 in, right? So in addition to the 140, I now have 190. I'm going to roll into my new house, but I'm going to spend 50,000 on a Tesla. The problem is when you take that 50,000 out, it's considered a capital gain. In other words, you won the lottery. You got some money out of the deal. Guess who wants a piece of that? Uncle Sam says, wait a minute, hold your horses. It may not be income, but it's like a bonus. It's a capital gain. It's like winning the lottery. You got to pay Uncle Sam for some of that. But if you roll it over, you don't have to. You don't have to. So if your tax is around 30%, the capital gain may be 16%. Why would you give money to Uncle Sam when you can move into a bigger, more beautiful house? Now, unless you have to. Yes, Jenny. Jenny, just read the announcements, because I do have to assign everybody companies. All right, so let's go back into the slides and let's get into those accounting sheets. All right, so we have a good understanding of how this works. Let's apply it. So if we go back to here, and we've gone to, so the first thing we want to look at is the balance sheet. So, and this one, the other one starts with the income. But if we look at the balance sheet, I want you to think of the balance sheet as when you go to the doctor, you want to find out how healthy you are at that moment in time. Not a year ago, not a year from now, right now. A balance sheet is a check on the company's health right now. It's a snapshot in time. So when we talked about asset values and things like that, right? So current assets, anything in accounting or anything in business, which refers back to accounting, is within a year. So from October 10th to 2023 to October 9th of 2024 is a year. So anything that's a current asset is something that has a value within the next year. And if it's a liability, it's usually something that I have to pay within that year. There's long-term asset and long-term liability, and all that means is it's over a year. If you buy a house or a building or a tractor or a commercial oven for your bakery, for your new restaurant, you probably are going to pay a mortgage on that that's going to last longer than a year. So that's considered a long-term that's considered an asset that's balanced by a long-term liability. The asset has a value on it, but it's also, you're paying a mortgage, you're paying a bill on it, so it's a liability. If you bought it for cash, it would be equity. So it's called there's a check and balance. There's a debit and a credit, and everyone gets confused over this. A credit is a decrease. A debit is an increase, and your nature would be to say debit sounds like the decrease and credit sounds like I got credited with something. It's actually the opposite. It's actually the opposite. So when you bought it, you took cash out, which means that you credited your account and you became an asset in your company. So you debited the asset side, right? So now when I look at here, I see that I have current assets that's worth 15,000. The market says it's worth 15. I have cash, cash is cash, right? So it's worth whatever the printed number is on the face of it. And we can get into why that's the case, but it's worth whatever's the face of it. I don't have any marketable securities like CDs and money markets, but I have accounts receivable. So accounts receivable is 45,000, right? that's money that I'm expecting to receive. So this is a delicious desserts company. So maybe I sell desserts to an office and they pay at the end of the month, and or businesses or whatever, but I don't get paid. Maybe the credit card payment doesn't come till the end of 30 days or whatever, but I'm waiting for my payment. So it's in a bucket called receivables, and eventually I will receive that money. And then notice it says less allowance for doubtful accounts. What does that mean? Doubtful means someone's not paying. There's always a risk that someone may not pay. And so after time, you begin to realize that, every year there's always a couple of accounts that don't pay up and we don't get that money. So you account for that. And you have to put it in here this way because you can't say that you have something that you don't have, right? So you have to account for that. So you subtract that number from 45,000 and it comes out to 43.7. So now I have my accounts receivable total at 43,700. I have notes receivable. Notes is a loan. So right now, if I go to the bank and I want to get a loan out, we know that it's going to probably be around 7.5%. But let's say I go to Apple Computers, which if I pulled up the screen, it would show that they have over $100 billion in retained earnings, meaning they have over $100 billion of cash. Dead presidents, they have cash, right? Maybe it's sitting in money markets and CDs, so they grow some interest on it, but it's cash. If they need it, they can go grab it, do whatever they need with it. Well, I can go to a bank and get the 7.5% loan, or I could go to another company and borrow money from them. And you may say, is that legal? Yes, it is. I can loan you money, and I can loan you money, and actually we can write up an agreement, and you have to pay me back my money. And if you don't, and you sign an agreement, I sign an agreement, and we get it notarized, I could take you to court and sue you for my money. So if I can borrow money from you, I can borrow money from a company. Now, why would I borrow money from a company instead of a bank? Well, just to speed things up, because they want to make money on their money. If the bank is giving them 4% interest, and I can only get a 7.5% interest loan, they can loan me money for 6.5%, 5%, 4.5%. It's still more than they would get in a money market or a CD, and I can get money. It's going to cost me less than if I borrowed money from the bank. And that happens all the time. Sometimes you may hear in the business reports, they say they traded some paper. That paper are notes. It's borrowed money. So if I'm Apple and you need to borrow money and the bank told you 7.5%, I'm going to loan it to you for like 6.5%, right? So I'm going to get some nice numbers. I'm going to get better numbers than the bank would have given me interest on my money with, unless I invested it somewhere. And you're going to get a nice situation because it's 1% less than the bank would have charged you for it, right? And I'm probably going to do it in the short term, meaning I'm not going to let you hold on to my money for more than a year because, I can do things with that money, right? And it's nobody's business but my own, but I can invest it. I can buy another company. I can introduce a new product. I can do whatever I want with it, right? And that's what notes receivable are, right? So I'm expecting to get $5,000. Maybe they loaned it to their supplier who was short money so they could create the supplies they need. And once they finish making it, then they sell it and then they can pay down their loan. And then inventory, right? So any of you who work in retail, like Macy's, a department store, furniture store, even a large grocery store, a couple times a year, you're forced to come into the company and count all the stock, right? If you don't count that stock, or if you do it wrong, the IRS can come in and audit the company and shut them down and take all the time they want to count that stock, right? You may say, well, wait a minute. You're telling me that they bring all these people into Walmart or into Amazon where the warehouse is 3 football fields long and they count it? Yeah. But the difference is the way they do it in those places is they have a robot and they tag every single item with an RFID, radio frequency identifier tag. And either the tag is active or it's passive and the machine on the robot is active. Either way, the robot goes up the aisle and all of the items announce themselves to the robot. And as it does it, all those pieces are counted. And if you remember last week, I showed you this robot walking up and down the aisle. That's another way they do it. They count every single item, because to count 10,000 SKUs of a grocery store, and each SKU has 1,000 pieces. So 1,000 times 10,000, right? What? It's a million, right? Because, or no, actually, it's 10 million. That's 10 million items. That's insane. And if it's 1 in 300 and 1 in 3 million. Humans make errors 1 in 300 times. Computers make errors 1 in 3 million times, meaning there's less errors in computers than humans. Humans make errors all the time. So more and more businesses are using robots to do this. But the IRS requires that they count it, because you have to account for your inventory, because except for the state of Nevada, you have to pay tax on inventory. New York, Texas, everywhere, you got to pay tax on inventory, right? But so you account for your assets and inventory, and then your total current assets is 83,200. So you add up this column and you come to this, right? So, and then I have my fixed assets. Fixed is just a fancy word for saying long-term assets. It's over a year. So my bakery equipment, I'm paying a mortgage on it. Notice this is less accumulated depreciation. So make believe it's a truck, right? And you drive that truck for 5 years, and every year you drive 20,000 miles. If I bought that truck for $100,000 and I drove it for 20,000 miles, actually, if I drove it off the lot, we all know that if you buy a car, as soon as you drive it off the lot, it depreciates. There's that fancy word, depreciates. But if it's my business truck and I drive that business truck for 20,000 miles, I can do what's called straight line depreciation over 5 years. In other words, I'm going to hold this truck for 5 years, and towards the end, I'm going to sell it for whatever equity I have in it and buy a new truck. But what it means is the asset value of that truck, which was $100,000, is now 20% less because I drove it 20,000 miles. The truck is not worth what it was when I bought it. It's a used truck, and I put 20,000 miles into it. So it's really 20% less. And 20% of 100,000 is 20 grand. 20 grand from 100,000 is 80 grand. That means that the value of that truck is 80,000 after a year, not 100,000. So it would be less 20,000 depreciation, right? And I would do that every year over time. And then I would list the asset value of that truck as 40,000, not 56,000, right? So the market says, I drove my truck 20,000 miles. No one in their right mind is going to give me $100,000 for that truck. In this case, they said we used our ovens for however they measure it, like how many cookies and cakes they made, or how many hours it was running, or whatever. It's not worth 56,000; it's worth 40,000. So I subtract out the depreciation and make it 40,000. And they did the same thing with the furniture. They bought furniture and fixings, and they depreciated the value of furniture because it got worn and beat up and stuff, and it's worth this. So the total fixed assets are worth 54,200. There's intangible assets. So I could have trademark, goodwill. Johnson & Johnson has patents. So my patents, an intangible means that I can't touch it, right? If you write a song, you can copyright the song for the words. If I create a symbol like the swoosh for Nike, I can trademark that so no one else can use it. If I create a drug that cures cancer, I can patent that. So for 7 years, no one else can use it. That's why in the drugstore, they wait 7 years, and then you see the store brand of that same drug, and all of a sudden the price drops, right? Because it takes about $1 billion to make a new drug. So they need to recoup all that investment, right? Plus the profit. So I can have intangibles. So it looks like they have goodwill. And what is goodwill? Maybe they gave some cakes and cookies to a homeless shelter. So that's goodwill. They gave something of value that was worth $4,500 just as being good guys in society, right? When you give clothes to the goodwill, they say you can depreciate, you can write it off on your taxes because you gave something of value, right? And so they're supposed to give you a receipt and tell you what it's worth and assess it, but they would be there all day doing it. So they say, here's the form, fill it out and give it to your accountant. And so everybody puts in a few pieces of clothes and everybody says it was worth $523, so that it looks real, right? if the IRS wanted to be a pain in you know what, they could literally say, okay, now show us the receipts. Nobody has the receipts, but that's goodwill. And so here's the value of your fixed asset, and your goodwill comes out to you know what? I think these numbers should be trademark and goodwill because they're kind of off. Anyway, they add these numbers up and it comes out to 11,500 for total intangible assets. Yeah, this should be trademark 4,500 and goodwill 7,000. And then you add this all up and it comes out to 148,000. The fixed asset, the current asset, and the intangible assets all come out to 148,900. So when I add this number and these numbers, they come out to this number here. Well, we already know from the equation that this number here better equal the liability and the equity. So if we move on to liabilities, this is what we owe. This is current, which means within a year we have to pay this. So I have to pay my accounts. Maybe maybe there's someone who makes some products that we sell through the bakery. Well, I'm assuming there's a bakery, and we get the product, and since we don't get the money until customers come in and buy the product, we owe money to the people who actually send it. So, like say, if you had a store and it was Entenmann's, you don't necessarily have to pay for the Entenmann's the day we receive it. They wait till the end of 30 days. People came in and bought it, then we pay Entenmann's for it plus a little interest, right? So there's accounts payable. It could be other things too, that notes payable, we borrowed money from someone. Accrued expenses. This means over time expenses accrue. Either a number of expenses that start to accumulate that we owe, or a number of expenses. It could also be an asset. It could be accrued money that we're supposed to receive, right? So it's expenses that build over time that we have to pay down, right? So this is 4,500, and then income tax. Obviously, we have to pay our tax bill, and then the current portion of a long-term debt. So maybe you're paying mortgage on the building, maybe it's on the bakery equipment, whatever it is. It's something that you have to pay for that takes more than a year. It could even be that bakery equipment that we were depreciating that we're still paying on. So your current liabilities that you have to pay within the year is this amount, 60,150. And then the long-term liabilities, the bank loan for the bakery equipment, right? So this is something that you still owe, that you have to pay over a longer period of time. So it's more than a year. It's 10,000. So your long-term liability is a total of 10,000. So now the current and the long-term is 70,150. So that takes care of our current and long-term assets, our current and long-term liabilities. So if I subtract 70,150 from this number, there's still more left. And we know from the equation that if I look at that equation and subtract the liability from the asset, it should equal the equity. So now we go down to, well, I guess it didn't say it. Oh, it's here, sorry. So the owner's equity, there's the common stock. So they have 10,000 shares of stock out, and the total value of it is 30,000. That means if I divide 10,000 into 30,000, it equals $3. That means each share of stock is worth $3, right? The next thing is retained earnings. So the previous year, this says 2018. So in 2017, the company made however much money in profit. That profit goes somewhere. It doesn't go into the owner's pocket. It goes into something called retained earnings. We are retaining how much we earn. It wasn't 48,750, but it was part of this, because part of the 48,750 also came from 2016 and 2015. And unless they spend some of this money, it becomes an accumulated amount of money, but it goes into this bucket of retained earnings. So your total owner's equity is the value of the stock, which is basically people who own the company, are shareholders or equity owners, including people in the company. and the cash that you have accumulated from profits comes out to 78,750. So now when I add equity and liability, it should equal the same as the asset, 148.9, 148.9. Does everybody understand it?
Yeah.
So this is why it's important to actually practice and play with this stuff, because it can be very confusing if you just look at it without some context. The next is the income statement, which is also referred to as the profit loss. Why? Because at the end, you're either going to have a net profit or a net loss. So sometimes they say the P&L statement, the profit loss statement, or the income statement.
Mhm.
The first line, and you're going to see revenue. People say, well, where's the gross sales revenue? If it says revenue or gross sales revenue, they're all the same. So in this case, the company at the end of the year, whereas balance sheet was a snapshot, the income statement, it could be a quarterly income statement, a 6-month income statement, or a 12-month. And most companies, like we saw in the Yahoo Finance sheet, is a year revenue statement. So the company made, and remember in the Yahoo, they add 3 more zeros. So in Yahoo, it would have been 275 million. But this looks like a mom and pop shop. They made $275,000. It says year ending December 31st, 2018. So that means their fiscal year ends on the 31st, right? Some companies can end, like Apple ends at the end of September, right? Because the company probably formed October 1st. This company formed January 1st, so it ends. And you can't change those dates. It's against the law because it's called manipulation. So the company made $275,000. Notice it's less discounts. So maybe they had some promotion where they gave discounts. And so they have to subtract that part out. You don't want to declare revenue if you don't have to, because you're going to pay tax on revenue. So you want to make sure you take into consideration the discount and then returns. Maybe someone didn't like your cupcake, or maybe it was a bad cupcake, or it was broken, or something was wrong with it. So you had $2,000, the value of the returns, or maybe you gave them something that was supposed to be hot, it was cold. They said, you know what, it's on the house. Sorry for the inconvenience. So allowances and returns and discounts come out to $4,500. Subtract that from here, and you've got $270,500 in actual revenue. And you want to be careful because you don't want to account for this, because you're going to pay tax on this number. So you want the smallest number possible. Now, the first profit is gross profit. And gross profit comes after cost of goods sold. So this is how much it costs to make what you're doing. The other one is operating profit, which is the amount it costs you to sell it, right? So the gross profit for some companies, if you're Best Buy, you don't make anything. You don't make anything. So the gross profit is always going to be big because you don't have any expenses. But if you make like student desks, your gross profit is going to be smaller because you spend a lot of money and expenses in making those desks. So you have beginning inventory. Now, where did beginning inventory start? The cost of goods sold, it started at the end of December 31st, 2017. On January 1st, 2018, this was your beginning inventory. So if you looked in your inventory or your shelves or whatever, you had $18,000 worth of inventory. And remember, even though you are a food service, this is only 24 hours, right? Your company closed on December 31st, 2017, and 24 hours later, you opened up on January 1st with maybe some cakes or something like that. But it was worth $18,000. And then throughout the year, it cost $109,500 for 12 months of product that you bought raw material and you processed and you made, or maybe you even bought some product or something. Anyway, it cost $109,500, right? So that's how much it costs for that throughout the year. And then the total cost available for sale, right, was $127,500, right? So if I add 18,000 to 109,500, it comes out to 127,500. At the end of the year, after everything that was available to sell, there was still 15,000 left. So for the entire year, I subtract this part out because this is going to become my beginning inventory of the next year. So my cost of goods sold just for 2018, I subtract this number from here and it comes out to 112,500, right? So remember, I'm only looking at money I made and expenses I spent on for my either profit or loss for the year, right? This is an asset, this is a liability, this is I made money, I spent money, and at the end of the year, I either made a profit or I had losses. So this, it cost me 112,500. So if I subtract that from this number, remember, if I was just a retail store, this number wouldn't even exist, or it'd be very tiny because I'm not making anything. But I'm a bakery or something, and it's costing me 112,500 to make all this stuff. I subtracted, so my gross profit after making everything was $158,000. And it's important because I'm going to compare this number to other companies. I'm either doing a better job or a worse job if I'm like to like. The next one is operating. So they call it SGA, Sales of General and Administration. So my selling, my salaries, advertising, maybe I put some promotional stuff together, whatever, but my total sales expense was 65,000, right? Doesn't look like they have a big staff. And then the general administration and combined, my professional and office salaries, so the back office, and remember, this could be a third party, like my accountant. My utilities, they don't seem pretty high. Maybe we're in Idaho or Kansas, but anyway, utilities at 5,000, office supplies, paper, staples, whatever, computer. Interest that I had to pay, because interest is an expense. I have to pay my interest payments because remember, a loan is a contract by law. You have to pay what you have to pay. Insurance, obviously, I've got a bakery, people eating food, someone can get sick, so I have to have insurance. And then my rent. So here are my expenses for that, right? So this is for selling, this is for operations and administration, total 50,100. So my total operating expenses are $115 and $100. So now I subtract this number from this number, 158, and now my net profit or my operating profit is 42,900, right? Now, if I'm Best Buy, this is the big hit because I probably have lots of sales staff, lots of rent and everything. So this is where that's why some businesses are more retail and some are more producers, and most of them are not. Apple, for instance, is in both cases. So they get a big hit to their gross profit and they get a big hit to their operating profit. In this case, this is the breakdown for that because they have a little store, right? Next, you have to pay tax. That's another expense, right? Uncle Sam says you got to pay the tax, and it's 10,725. So you subtract that from this profit, and then your net profit, right? So this is operating profit. This is net profit. Sometimes you hear this referred to as EBITDA, earnings before interest and tax, and you have EBIT and EBITDA. So it's earnings before interest and tax. And this is net profit. This is your final profit. The only other thing that you might pay out if you're a company are dividends. So dividends is a share of the profit that you're willing to give to your employees. So dividends always comes after this, but not every business pays dividends. So if you have older relatives who work for companies and have a lot of stock, they usually transition that stock into dividend stock because it will pay out money per share. So if you have a relative with 10,000 shares of stock, they may be getting $1,000 or $2,000 a month from their dividends on their stock, right? Because they're older, they're not working, and this is part of their retirement income is that their stock produces. And then when they pass, they give it to you, their kids, and either you as kids continue to use that dividend and then buy more stock, which increases, and this is part of generational wealth, right? All right, and so we understand that the balance sheet, we understand the income statement, we understand that the balance sheet is a health check on the company. We understand the income statement is a statement of after you make money, you pay your expenses. Did I make a profit or not? And remember, this number, 32,175, will show up in 2019's retained earnings. They will add this number to the one we saw previously here. So they're going to add it to the $48,750. They're going to add that $32,000 number. So it's going to be around $80,000 after they add it on. Yeah, this number. They're going to add it to that number. That's where it goes. So in the 90s, businesses were failing and they didn't know why, because they say, well, wait a minute, they made a profit. Why are they failing? Well, the problem was they didn't know, they were running out of cash at the wrong time. And then companies decided they wouldn't work for them. Employees would quit because they weren't getting paid their salaries. So let's say that you are a company that sells stuff for the summer and you spend a lot of money to produce it. And then in March, or April or May, you run out of money, but you know you're going to get all this money in June, July, and August. And your employees are like, look, I got to pay the rent. I don't care what you tell me you're going to do in June, July, and August. You better give me my money. And so unless you borrow that money, I quit. Or the supplier says, I'm not supplying you anything until you pay me. And so companies were getting into a lot of trouble. So if you're a publicly traded company, the SEC said you are required to provide a cash flow statement. And a cash flow statement is not about a health check. It's not about profit and loss. It's about cash coming in, cash going out. And there are sophisticated ones that are broken down by month. And then some of them have special rates and stuff. That's an accounting course you can take. That's beyond this course. So I'm not going to complicate it. But notice it said net profit after tax, right? 27,175. So the profit after tax for the 2018 was this number. The depreciation, and that's a positive number, right? That's a positive number. The depreciation was 1,500. Anything in a parenthesis is negative. Anything without a parenthesis is positive. But remember, depreciation was how much you wrote off that truck, how much you wrote off that gear. And you may say, well, why is it showing up as a positive number? Because it's a positive in your account. In other words, you don't have to pay tax on this 1,500. This is money that you get to keep, right? So this is a 1,500 plus. Decrease in accounts receivable. It says decrease, but it's accounts receivable. That means that you actually got the money. So the bucket of accounts receivable dropped by $3,140. You received $3,140, right? The next one is increase in inventory. Well, I can't get inventory unless I buy it. So therefore, money left my company. It cost me $4,500 for inventory. A decrease in accounts payable. I had to pay the money out. That means money left the company, right? So it's a negative. Decrease in accruals. So because they were expenses, I had to pay these expenses. That means money went out. That's a negative. Cash provided by operating activities. So this is the operating activities of cash flow. Thank God for the net profit up here. It's positive, 24,215. It's not negative. Then the cash flow from investment, right? Increase in gross fixed assets. I bought, if it's that bakery, maybe I bought some furniture, or I bought a new counter. That's money I spent. It went out. Cash on used in investment, total negative 5,000. Cash flow from financing, right? Paying loans and stuff. So decrease in notes payable. So I owed money that I had borrowed that cost 3,000. So it's a negative 3,000. Decrease in long-term debt, like on that bakery oven. So I paid money out of $1,000, right? So my total out was 4,000. So I have a -5, a -4, and a plus 2415. So my total cash flow, I don't know, I'm assuming this is for the whole year, because I could have it by month, by every quarter, every 3 months, every half year, every 6 months, or every year. So let's say it's a year. So my cash flow for the year was $15,215, right? And so it's even more important when you do it by month, because it helps the company know, are we positive cash flow or are we negative cash flow? right? Right. And then there's the ratios. And so the ratios look at the performance of the company. Look, you have liquidity, profitability, activity, and debt. Liquidity is really straightforward, right? Liquid means you have money, you have cash, you have positive cash. So if I take all the current assets, which we saw in the balance sheet, and divide by the total current liability, so this is all within a year, right? You want this number to be greater than one or greater. Because if my assets are worth less than my liabilities, you go to borrow money for a house and they say, you owe 100,000, or you want to borrow money for anything, you owe $100,000 on your house. Your assets is your car, which is worth $20,000. You are negative $80,000 in assets. You're probably not going to get a loan. But if your house is worth equity 100,000 and you owe 20,000 in your car, you have 80,000 in asset value on your house on the top side, and only 20,000 on the bottom. They said, yeah, because if anything happens, you can sell that house. You're worth 4 times your debt value. So it's always great to have more asset value than liability. In this case, they have 83,000, so they just added up all the total current assets and added up all the total current liabilities, and it comes to 1.4. Now, where this becomes helpful is I can compare my bakery to another bakery, and if it's publicly traded, or if you can have a trade organization can tell you, and then census information from the federal government will tell you, on average, a business, say in Bedford-Stuyvesant that's running a bakery, their current asset ratio is, and they'll give you a range, and you can figure out, am I in the range or not? And it tells you I'm either doing a good job or I'm not. It also helps if you're asking for investment, they say you're doing great, so we'll invest in you. Your asset value is greater than your liability. Now, what's the difference between a current ratio and a quick ratio or an asset ratio, or they can call asset test? So if I have a sneaker store, and at the beginning of the year, I bought some sneakers from Reeboks, and it turns out nobody likes those Reeboks. You know, back in the day, we call them rejects. Like, nobody wants some bum sneakers. And so they're sitting up there on your shelf. And remember, you're paying tax on that inventory, and it's called a lost opportunity cost. You dropped 100 grand on a bunch of sneakers that nobody's willing to buy. You don't have that 100,000 that you should have bought maybe Adidas or Nike. So what they say is, here's what your total current assets are, including inventory. But what if you're in a business where inventory can sometimes be really good or really bad? So what is the one where you subtract out the inventory, right? That number is going to drop because the inventory is worth a lot of money. So they subtracted out inventory of 15 grand, and they still came out positive at 1.1. It's over 1. And then again, you want to compare that to the industry, because like if you're a sneaker store and one is buying all the right product and the other is not buying the right product and you subtract it out, this is probably where it's going to show up. And that's going to affect your ability to raise money. And it also makes you think you are not being managed well because you're buying the wrong product. You have so you better hurry up and discount those 100 grand of sneakers and then write off the loss from the sneakers, right? So the next is working capital. This is real easy. My total current assets minus my total current liabilities, this better be positive. This gets back to the one where I say your house is worth 100,000, your car has a loan out that's worth 20,000. So if I take 100,000 minus 20, I'm worth 80,000. You always want this to be positive. You do not, when it's negative, like in 2008 when houses were underwater, their house value, the liability was greater than their asset value. Like there was no equity left in the house, and it even eat into the down payment. And so the $500,000 house was the note, and the house was only worth 380,000. They owed 120,000. People were walking away from their houses. They were kicking a hole in the wall, stealing all the appliances, and leaving the keys in front. And said, "I don't care. You can bankrupt me or whatever. I am not giving you money for a house that you took 140,000 out of my pocket because the economy is bad, and you want me to pay on this house?" And they were losing their jobs, right? So this is liquid ratio, like, you know, asset to debt, what you value. The next is profit. Are we making money or are we not? So net profit, that's the final profit over net sales, right? That's a sales revenue. So what they're saying is, for every dollar that you make, how much is profit? So what if you made $100? What they're saying is $11.90 is profit. So here's the profit, here's the sales. So for every dollar, it's 11.9 cents. For every $100, it's $11.90. For every $1,000, it's $119, right? And sometimes profits are low. Grocery stores around the country, on average, make around 2.5%. That means for every $100, they make $2.50 profit. The real estate's expensive. The inventory is expensive. Grocery stores are labor intense. The labor is intense, and there's stiff competition. Trader Joe's and Whole Foods make around 16.5%, 17% because they don't sell food, they sell lifestyle. And because they sell lifestyle, they sell to people who make a lot more money than people who just going in to buy the eggs and bacon, right? And so they sell it at a premium price and they make more. The return on equity. So again, the net profit, but now it's over total equity. So for every dollar invested, how much do you make profit, right? And so the question is, do I want to invest in this company, right? Because for every dollar I invest, are you making more and more profit? So I want to look at year next to year next to year. So 2018, 2019, 2020. And how are you compared to another company? How does Adidas compare to Nike, right? I want to compare the companies because I want the one that makes more profit. Because if they make more profit, the stock goes up. The stock goes up, my stock is worth more money, and I'm a happy camper, right? So you can see why this is important. The next is earnings per share. So net profit again over the number of shares. So based on the number of shares, how much is each share worth? And you obviously want this to go up. You obviously want this to go up because if you buy a stock for $100 in a year, I would love for it to be $120. That's a 20% gain. And then the following year, and the following year, and the following year. So I'm looking at EPS or earnings per share. And I want to compare it year over year. And that's when they say the earnings per share went up 2 cents. And you're like, that's nothing. But it's something if you have 1,000 shares. And it's something if it's going up every month by 2 cents, right? And sometimes it's $1 or $1.20 or whatever, right? After they do the report. The next is inventory turn. So this is about operations and how the company is managing itself. So the cost of goods sold, which we saw in the income statement, right? We saw beginning inventory, final inventory, and then average. So here's the cost of goods sold. We can take that from that sheet on the income statement. And then we take beginning inventory plus ending inventory. So 2017, 2018, divide by 2. That's why it's called average. And we come up with this number. And then we divide that number into this bigger number here, the cost of goods sold. And it comes out to 6.8 times. Now the question is, what does that mean? So let's say it's the gap. And let's say that the number is 12. That means 12, and let's say that the inventory on the floor for that store is $1 million. If you add up all the inventory in that store, downstairs, on the shelves, sitting on display stands, it all comes out to $1 million. And so my number is 12. That means 12 times a year, I flip the entire store. That means that I make $12 million a year because I am turning $1 million. Now, maybe one month it's 1.5 and the other month it's half. All I'm care about is that if I average it 12 times a year, I turn my inventory that's worth $1 million. Now, how do I use that? Because I would love to increase it. What if I am able to use my do merchandising better? My displays are better. My sales training is better. My salespeople do a better job. I pick the right inventory so that people want to come in. Maybe it becomes hot and trendy and people really interested. Maybe it's stuff you use when it's cold out and I'm selling more because of the season. There's a million different reasons why I can increase it. But at the end of the day, it's how I manage my store. And so what if that number goes from 12 to 16? That means that I'm flipping my store 16 times a year. That means that I'm now making $16 million a year. So this number is helpful because the number can go up or the number can go down. And if the number goes down, it's taking me longer to turn the inventory. If the number goes up, that means I'm flipping more times within, because 12 months is fixed. It's just a question of how many times can I flip it within 12 months? And the bigger the number, the more money. So that's why this is a really helpful number. And it's not just stores. If I look at an airline, Southwest will go from New York to Boston and back. And they'll look in the air, and so let's say the plane holds 300 people. And they're like, we can get a flight back and forth in one day 7 times. If I can get one more flight back and forth, that's 8 times. I can multiply 300 times 2. I've increased my daily income. My fixed costs are the same. The plane doesn't cost anymore. I pay a little bit more for fuel, a little bit more for staff, a little bit more for some peanuts, and a little bit more for the gate fee. But I just made another flight worth of money. I could do that the same way with a hotel, right? How many times can I turn the room? It's a little hard because people don't normally leave in the middle of the day, except for certain hotels that rent by the hour. How about a theater? Can I add one more time? Like now pregnant women are going together in the 11 o'clock show in movies because they're all with their nursing babies. And so a lot of movie theaters in veteran communities are now opening it up early, and they say you can come in for free if you buy concessions. And so pregnant women are using it as a way to socialize, and they get to see the movie. And then hopefully their families come in and become loyal customers to the theater. So there's a lot of different ways you can use this number in different industries. And then the last one is total liability over owner's equity. So again, we look at that total liability number from the balance sheet over the equity. And they come out with 89.91%. Now, where does this come in? Every time you get a credit card, this pops up. It says, how much money do you make? In other words, what's your value for the year, and how much do you pay out? And there's a magic ratio. They say, well, if you're paying too much out, then we will give you a credit card, but it'll be at this much value. Like we'll give you 2,000. We'll give you 10,000. We'll give you 20,000. Right? Same thing with a loan. How much do you make per year? How much do you pay out? And how much you're trying to borrow? They said, well, you wanted 10,000, we'll give you 5. You wanted it at 7%, but based on your debt equity ratio, we're going to give it to you instead of 7. You got to pay 10%, right? So that's where these numbers come in handy, because when people look to borrow money, and then sometimes investors look at it and say, how much money, if you take my equity money and you make profit off of equity, I don't like it. I want you to borrow money. The bank says, you borrowed my money and suddenly your stock price went up and you paid out more dividends. They say, I don't like it. You should pay it on the equity. And so they always look for a balance. They always look for a balance, right? So this is all about performance. All right, so those are the sheets, right? I realize I've gone over a little, but I wanted to make sure we got this covered. Are there any questions about this? Are there any questions?
I think it's good.
Yeah, because what I would do if I were you is because I'm going to ask you to do something, not right now, but I need to basically announce it. So yeah, so yeah, I would look at the companies. So wait a minute, let me get to here. So let's do the attendance picture, and then I'm going to show you something. As soon as I find it, where's discussion board? Where's discussion board? So I've set this. I stayed up last night doing this. As soon as it pops up. Come on. As soon as it pops up. There we go. So I'm going to do 2 things. I'm going to show you this, and then I'm going to take the attendance picture. All right. So in discussion board, if you look at all the way down, you're going to see a long list of, by the way, some of you still haven't done your assignment. See this? It says, it has companies and it says student. And if you keep going down, there's more and more. And so I created a list of companies that's more than the number of students in the class. And what I need you to do is pick a company. See, this is the second row of companies. So I created a long list of companies. and you're gonna go in there and pick one. And so what's gonna happen is you're gonna email me, and it's first come, first serve. And the way that works is the email is gonna tell me the date and time. So if you pick a company and someone's already picked it, whatever the email tells me came in first, they get first shot at it. So I would pick like 2 companies, because if you don't get your first, I'm gonna give you the second. And if it's the same kind of industry like Coke and Pepsi, I would pick a different one, because if someone picked Coke, someone else is picking Coke and Pepsi. So just be kind of mindful of that. And so there's an assignment, I guess I'll put it in the announcement, but I want you to look at the company. I want you to know who the company is. I want you to look up the financials on the company. I want you to start getting to know the companies, because this is going to be your company for the project for the semester.
Did you assign it to us yet, or?
No, you're going to pick it.
Oh, we're just gonna pick, okay.
You're going to pick a company. So, because some people have more interest in one thing or another. Like I've got transportation, I got car companies, motorcycle companies, Coca-Cola. For the ladies, I got the beauty product things that I don't know anything about. I got, a bunch of stuff. Ralph Lauren's in there, Gap's in there. So if everybody could turn your images on so I can hurry up and take your attendance picture, so you guys can all get going. Apologize for the delay, but we have to get this done. So Quinn, Harlan, Ryan, Ashley, Brian, Ambra, Matthew, if you can turn on your images. So today's class is brought to you by, let's see, I think I already tried this hunter's hat. I think today I bought this hat. I was inspired by Raiders of the Lost Ark. So I'm gonna wear this hat today.
There you go. That's a Sala hat right there.
There we go. So I'm gonna wear my hat. Quinn, what do you got? I thought you were sponsored. Oh, all right, Kleenex. And Anna is sponsoring it with now you're making me hungry. Miracle, where are you? Harlan sponsoring with his glasses. Nicole is sponsoring us with that. I don't know if that the Disney character. Ashley, I don't know where you are. Brian, oh, you got lip balm. Matthew's got icy hots. Ryan has got a brick wall. Adiana's making me hungry too. Okay. And Martin's got his phone. And Ambra, where are you? All right, so let me frame the shot. Quinn, get up a little higher. We like your eyes. There you go. All right, here we go. Here we go. Here we go. Ready? On 3. Oh, I got to look this way. 1, 2, 3. There we go.
Beautiful.
Thank you, everybody. So I will send out an announcement with the same thing, but you guys are here, so you're obviously going to hear it first, so you get first crack at it. I would go in there, finish the assignments, please. Oh, Ashley said, it's giving this is America. What? It's giving this. I don't
The
understand.
movie This Is America. That's what your hat is
movie, the
giving.
movie. Thank you. Oops. And pick your company, email me as soon as you know, because first come, first serve. And then oh, and Quinn, you're gonna be my teacher for a hot second, because I don't know what the heck I'm doing. I'm destroying my plants. And
It's okay, buddy.
he's like feeling bad for me. That was good. I like that, John. He's like, it's okay. So, and by the way, if anybody likes her, I saw Samara Joy on Saturday. So if it means anything, she won 2 Grammys. She just graduated SUNY 2021. She's only 23.
Wow.
Jazz singer.
Good for her, man.
I actually met her. I took a picture with her. I like floored. I mean, she's super young and she sings like Sarah Vaughan, which is too old for all of you guys.
It's crazy when kids they realize their talent when they're super young and they're just crushing it already.
She just kept saying thank you all night, so she's still so.
Good for her, man.
She only started singing in freshman year in college, and her
No
band
kidding.
were classmates.
Good for her, man. That's cool.
All right. Oh my God.
All right, Professor. I'm gonna get out of here.
All right.
I'll see you tomorrow.
Care. All right. Take care. Oh my God, Quinn, where did you go? You're supposed to help me. Quinn, come back.